actionable. So there are crazy things that they're out there looking at, and I think we should all be over-prepared for additional and significant scrutiny.
Well, this is a huge topic. I mean, the regulatory environment is changing rapidly. Somebody at a conference earlier in the week described it as a jump ball for different regulators, and there's so much being bantered around. But if you step back and say, what are the regulators' functions? One of the important ones is surveillance of surveillance and consumer protection. I think there's no way that the SEC could ever be staffed well enough to go in and evaluate managers and find fraud. They will occasionally find fraud, but they will never find all fraud. And so, to expect them to be able to do that is I think it's unrealistic. Having said that, the SEC could do a much better job of using, coming back to a comment I made before about using statistics. You can look at the returns on managers and understand whether they're unusual or not, and particularly look at it in context of what they say they're doing. This is something that academics have been doing for years to understand the covariation between managers and the covariation between managers and asset classes. And here it's strategies, and that's one of the, as you all know, the story of Madoff today. That's how the whistleblower observed there was something funny. Statistical techniques can be used to improve the quality of surveillance. A bigger issue, I think, of regulation is trying to minimize systemic risk. And obviously that's a bigger issue today now that we've sort of been through systemic issues. And here I think the Bank for International Settlements is taking a good strategy and probably a very likely one where individual firms will be taxed as a function of the size of their leverage. And this is a broad comment about financial intermediaries. We probably should distinguish between a bank, which is warehousing risk that's commonly held by a lot of other hedge funds that maybe is not supplying liquidity to the market, versus a manager that is taking opposite positions to the broader crowd. But having said that, the larger the leverage, so the bigger the institution, the bigger systemic risk, and that probably has to be managed at a regulatory level. So we know there's more regulation coming down the pike. Those are the two things I think that regulators should be thinking about. The one that I worry about, the worst that we're all talking about right now, are stamp taxes and transaction fees on trading. And talking about killing liquidity, it seems like that's the worst thing they could possibly do. And yet it seems to be the most commonly discussed way to raise money from everyone in this room. So I worry about where politics will end up taking regulatory policy in the coming years.
Michael.
Yeah, I'm not sure we have many insights on the regulatory side. It is nice to remind everyone that no hedge fund has ever been bailed out. This was largely a banking problem, one of the most highly regulated industries of all, and look what happened. So the government just would. The skew is much more to the left of what they do, I think, than the right. Hopefully they have learned. Hopefully politics won't, intervene so much. And we do need some more oversight and regulation. Mark, you mentioned, Madoff. Even when it's given to you on a silver platter, look what happens. And there's a tendency to get some non-meaningful but low-hanging fruit, as opposed to, being more intelligent about matters like you suggest, Mark. So, you look at last year in the short sale ban, we're in the midst of unprecedented crisis, and I'll give the Goldman alums high marks. They probably did prevent a financial meltdown, but what were they thinking, on withdrawing liquidity when you most needed it? Well, we're all in uncharted territory. Hopefully they don't damage liquidity going forward. It's very important. Not many insights here, though. We're just trying to be aware that there's huge governmental risk, try to stay on top of it as best we can. In fact, we're probably going to retain a research shop with particular strengths in Washington, D.C. to help us out here, because we feel so strongly about it.
Thank you. Jaeson?
I don't have too much to add to that. I think my colleagues did a great job. One thing I would just want to kind of talk about for a minute is the European directive. And I don't know if how many of you know it's coming or what it is, but I see that there are a lot of people in the investor relations side of the business here. And that's effectively gaining a lot of strength in Europe. And it really is going to kind of set the standard for what European managers can do in terms of leverage, transparency, and so on. It's fairly onerous. But one of the issues that might be affecting U.S. hedge fund managers is the fact that if you're not regulated by the European directive in some way, you won't be able to sell in those markets. So if you haven't looked at it, it might be a good time, probably a little late in any case, but it's always a good thing to look at because that could really crimp some of the things we're doing over there.
Makes sense. Thank you. One last closing question, then we'll take some questions from the audience. Broadly speaking, and certainly some of this we've covered in the course of the prior questions, but what have you or your firm done to adapt, or what do you believe is necessary to adapt to all these moving pieces? Start with David.
You know, we're in a service business, and clients are critically important. I think as we talked earlier about the lessons learned, matching clients' desires with the philosophy of the investment that you're offering is critical, and educating them as best as you can. So our key adaptation through this cycle has been to try even harder in educating clients so that we match up that time horizon of their investment needs with what we do for a living in terms of managing their money. And that will solve a lot of the issues related to liquidity that we were talking about, because if they're going to give you that commitment when they understand what it is that they're committing to do, hopefully you can preserve and do a better job at managing their money. So we've done even more at client education and reaching out in a better way of communicating with them to try and offer as much as we can, and listening to what they want from us. So one of the things we heard through the cycle was a real desire to get more engaged with our firm in terms of distressed investing, and so we launched a product over the summer to appeal to that, and I guess I was right in listening to them, because the money's flowing in, and that's always a nice thing to have happen to you when over the prior period money was flowing out. So listening to clients and communicating with them is our key adaptation.
Well, being self-critical for a moment, I'll be straight up and say, as a quant, we completely underappreciated the amount of crowding in the quant space. It's probably true for lots of different strategies, but we tended to operate as though we were in our own little world, a little partial equilibrium where we could do things and it would be uninfluenced by what everyone else is doing. And I think that's a bad strategy. We've obviously changed that, had changed it prior to my departure at Goldman, but a big focus of research prior to my departure was about trying to evaluate what other people are doing, because you're part of a broader equilibrium. And that includes things like just knowing where people are today, as well as trying to predict their behavior. And particularly people that are related to you, that are correlated with you, you want to know what they're doing. And so a big part of our research was focused on differentiation in factors, differentiation in the way we traded, trying to look for spillover in risk aversion or risk-taking by the broader marketplace, which often results in deleveraging or releveraging in short periods of time. So I think those are the things that we most learned from the quant perspective.
Thank you.
Yeah, same as there, a lot more client hand-holding, more risk management I mentioned before, more liquidity. The industry has evolved and is evolving nicely to find creative and different ways of injecting more liquidity into your portfolios. So we're doing that, and of course the great financial crisis served up what everyone knew beforehand, not now, just now, but one of the greatest opportunities of a lifetime, particularly with regard to credit strategies. So we've tried to take advantage